Hi everyone, welcome to the channel. I'm Sebastian Boyer, the approved guy, and on this video, we're going to be going over infinite velocity or accelerated debt to wealth transfer. This is going to be a new take, a new perspective on your debt elimination strategy. Without further ado, let's get right to it. The most valuable asset we have is time, and somehow it's also the most elusive. Many of us are planning on paying off our debt and saving money for retirement and for our family legacy. Before you know it, 5 years, then 10, then 15, 20, 30 years pass by in a heartbeat. And we all say the same thing. Where did the time go? Sadly, 74% of Americans don't have 2 months of savings to cover an emergency, and 40% have no retirement income. The average American household pays $1,583 in debt payments every single month. That's just about $19,000 a year. And over the span of 30 years, that equals $570,000. The standard protocol is not working. It's time to make a change. Step 1 is to know your 4 numbers: income, debt, expenses, and cash flow. Your income is your net income after taxes, what you bring home. Your debt is your monthly payments on your credit cards, mortgage, car, and your actual debts. You want to separate that from your expenses. And that's a mistake that most people make, is they blend together their expenses and their debts so they see no end in sight because they don't have a clear definition between the two. Your expenses will never end. They'll always continue. Gas, food, electric, etc. These are expenses that you will always have as long as you live. However, your debts have a deadline. So make sure you separate them. And when you list your debts, make sure you include the balance, the interest rate, and the minimum monthly payment. For your expenses, you should itemize your expenses so that you're able to see where your money's going. Just by practicing this activity, most of the time you can uncover between 5 to 10% of cash flow in unnecessary expenses. Believe it or not, most of us are eating our savings. We're spending our money on unnecessary dining, on restaurants and food, and that's where our money's going. Some of us are spending too much money on gaming, on entertainment, and on unnecessary subscriptions. So by just going through the process of listing your debts, you're going to be able to be clear on what you owe that you can pay off, and your expenses, you're going to be able to see where you're bleeding, where you're spending too much, and where can you cut back. If you're serious about eliminating debt and being cash flow efficient, well, it's time to be disciplined. It's time to be committed. It's time to get serious about streamlining how you're spending your money. And you want to give every dollar a job. If you don't give that dollar a job, it will get spent. And that's why you'll say, I don't know where the money went, because you did not assign a job to that dollar. So no dollar can have an unassigned task. Every dollar has to have a purpose, even if it's for entertainment. You create an entertainment bucket and allocate how much you're going to spend on entertainment. You create a food bucket or dining bucket, and you allocate how much you're going to use to pay for dining. You create a savings bucket and you allocate how much you're going to put to saving. By doing that, you know that that dollar has a purpose. So when you go to spend it, you'll stop yourself, because you're going to say to yourself, no, that dollar is allocated for that purpose. If you don't assign a purpose to your dollar, your money will get spent, and you will hear yourself saying, I don't know where my money was spent. I don't know. I can't figure it out. That is what a common thing I hear people say is, I don't even know where I'm spending my money. That's because you don't have it allocated. So that's very important. So what's going to be left over once you take your debts and your expenses, your monthly debt payment and your monthly expenses from your monthly take-home income, you're going to have your discretionary income. which is your cash flow. Now, with your cash flow, that's what we're going to be using to help you speed up and pay off more debt. So now you're going to choose a debt elimination method. You have debt snowball, there's debt avalanche, there's the cash flow index, and of course, velocity banking. Debt snowball was made popular by Dave Ramsey. And basically, it's a method of compounding your payoff allocation to the next debt. So when you pay off your first debt, you take the money that was being spent on that first debt and you reallocate it to the next debt. When you pay the second debt off, you take the money from debt number 1 and number 2 that was being spent to pay those debts, you reallocate it to debt number 3. So you're compounding your debt payoff. The mistake most people make is they take that now available money because they paid off that first debt and they go spend it frivolously. Well, that is not a very efficient and wise use of that extra cash flow. What you want to do if you're serious about eliminating debt is reallocate it to the next debt so you compound how you pay off your debt. Debt snowballing is a hierarchy of payoff based on the lowest balance. And the idea is that you'll pay it off the fastest, so you'll feel accomplished, makes you feel motivated to continue to pay off your debt. That is not the most efficient way. Though it is an efficient way, and it's better than not having any strategy, it is not the most efficient way. The next way is debt avalanche. Debt avalanche is based on the highest interest rate. Debt snowball is more efficient than debt avalanche, but debt avalanche makes some people feel better because they're interest rate sensitive and they just feel good about paying off the highest interest rate. If you feel good about something and it's going to motivate you to keep going, then make sure you do it. But technically, the most efficient order of paying off your debt is the cash flow index. The cash flow index basically pays off the debt that has the minimum amount of remaining payments left, and you put it in that order. So you take the balance of the debt divided by the monthly payment. That's going to tell you how many payments you have left. And then you put it in the order of the smallest or the lowest amount of remaining payments to the highest amount of remaining payments. The debt that has the highest amount of remaining payments is the debt that has a better cash flow index. The debt with the lowest amount of remaining payments has a lower cash flow index. And so you pay that one off first, and that will free up more cash flow so that you can reallocate funds with your compounding debt payoff strategy to eliminate the next debt and the next debt and the next debt. So the cash flow index is the most efficient way. Sometimes it does match with snowball in that it's going to be the lowest balance, but not always. Just because you have one debt with a lower balance doesn't mean that it has the lower amount of payments to pay off that debt based on the interest rate and the amount, the minimum payment that's due on that debt. So the cash flow index is going to be a better order or hierarchy of paying off the debts if you want to be as efficient as possible in your debt elimination strategy. Now, to take your debt elimination strategy to the next level, then we can introduce velocity banking. However, velocity banking is not for everybody. Number one, you have to have good credit because you have to be able to qualify for a revolving line of credit. Number two, you have to have enough cash flow available in your personal economy that you can put into that line of credit to reduce the average daily balance. Let's speak on that a little further. So snowballing, avalanching, and cash flow index is simply taking your cash flow and directing it to pay off the debts, and you're going to compound that interest payoff. After paying off the first debt, you reallocate that payment to the next debt, then you rinse and repeat until you get to zero. Now, if we introduce velocity banking, then what we're adding into the equation is a line of credit. A line of credit is simple interest and it's a revolving account. The calculation of the interest rate is based on the average daily balance of the line of credit. So by putting your income and cash flow in the line of credit, it reduces the average daily balance, which lowers the effective interest rate. As a result, you pay less interest, and by paying less interest, you have more cash flow that you can reallocate to paying off debts. That's why velocity banking works, but it's also why it doesn't work in every circumstance with every situation, because if you don't have enough cash flow to reduce the average daily balance, then you're not going to be able to reduce that effective interest rate, and you're just causing yourself an extra step and more work. It also requires extra discipline, extra commitment, and extra focus and time to be able to practice velocity banking. So it's not for everybody. Just because it sounds good and it looks good doesn't mean that you should practice velocity. Some of you should just stick with cash flow indexing and compound debt elimination payoff strategy. That's what you should do. If you don't have enough cash flow, if you can't qualify for a line of credit, and if you can qualify for a line of credit and you do have enough cash flow, but you don't have the commitment or the discipline, and you're not willing to really uh, focus on the strategy, then don't just do it haphazardly. And also make sure you work with a coach, someone like me or Denzel Rodriguez, or any coach who's available that can help you in your debt elimination strategy. Okay, so that is velocity banking. You're going to reduce the average daily balance with your cash flow and income, which is going to allow you to pay less interest, which with your compound debt payoff strategy of the cash flow index order, you're going to speed up how fast you pay off your debt. Now, for velocity banking to work, you have to get a line of credit. So just to quickly touch on lines of credit, there's your home equity line of credit. That's usually the best option because it's going to give you the biggest line of credit. And it could be a second mortgage lien line of credit, which is standard. But in most cases, a better option would be a first lien HELOC if you can qualify for a first lien HELOC. Now, if you cannot qualify for that because you just don't have equity in your home, but you still have good credit, you can also use a personal line of credit, and you can also use a business line of credit for your business. Credit cards, whether they're personal or business credit cards, are not to be used for velocity banking as the only instrument for eliminating debt, but as a supplement, as an add-on to your strategy. Now, if you can get access to 0% credit cards, certainly you can use 0% to pay off some of your debts and transfer the debt to 0% during that period. But you want to make sure you pay off those credit cards during that 0% promotional period. However, 0% or not, if you have credit cards that give you cash back, rewards points, or travel points, then you want to use those credit cards to pay for expenses like groceries, like gas, and other expenses that you can pay with a credit card. What that's going to do is give you cash back and rewards points, which is a stream of income coming back to you, which is tax-free. The key is not to spend the credit card on things you cannot afford. You're only going to use the credit card to pay for things that you can afford, and you're either going to pay it back the same day before the end of the day, you're going to pay the credit card, or you're going to make sure you pay it back before the payment cycle so the credit card does not accrue any interest. The key is to not accrue interest. You do not want to use a credit card to pay for things you cannot afford and then sit on the interest. Credit cards are compounding interest, and it's the worst thing you can do is pay the minimum payment on a credit card. So you want to use it strategically and wisely to rack up the points, rack up the cash back, but pay it off immediately or before the end of the cycle so you do not accrue interest. And that's how you use credit cards in a strategic way. You can rack up thousands of dollars of cash back, and you can travel for free if you focus on the rewards points. So for that, again, we schedule a call to get coaching and support on these strategies. So now, if we're going to practice velocity banking, we're going to be using the cash flow and income, putting it in the line of credit, which is going to reduce the average daily balance, lower the effective interest rate. With our credit cards, we'll pay for expenses to get cash back and rewards points. If we can get 0% cards, we can also use that to eliminate some debt in the meantime. And that's great. That is a great way to eliminate debt efficiently and quickly. And at the end of the cycle, you're going to have a zero balance on your debt, and that equals a smiley face. However, if you're only paying the debt with the debt snowball, debt avalanche, or cash flow indexing, because you don't have a line of credit, At the end of the debt elimination, you still have a zero balance in your checking account. And so that's not bad. So we're not frowning, but we're not excited either. With velocity banking, at least you're going to have available equity in the line of credit that you can now leverage for wealth building strategies, investing in real estate, cryptocurrency, the stock market, your business. But now you can use that equity to start building wealth. What if, however, there was a better way where instead of just paying off the debt, you could transfer it into wealth? What if you could transfer the debts you owe into debts that you own? Instead of paying directly to your vendors and creditors, you would transfer the debt into your high cash value whole life insurance policy. This is a debt to wealth transfer, otherwise known as cash flow hacking, infinite banking, or becoming your own bank. Your cash flow and income now goes into the whole life policy, which is going to give you guaranteed compound interest growth, which is uninterrupted, and it's tax-free growth. Tax-free, uninterrupted, guaranteed compounding interest growth. It's a safe and secure place to store your money where at the same time you can borrow against the cash value of the policy to invest in your business, invest in the market, invest in real estate, invest in whatever you want to do, as well as investing in paying off your debt. So before you pay your debt directly from your checking account, you start with your own bank. You fund your bank, which is your whole life policy, the cash value of your whole life policy, and then you borrow against it, and then you pay off the debt. In the meantime, the policy is uninterrupted. The growth on that portion that you've borrowed does not stop. So your money is now doing two things at the same time. So if we introduce velocity into this strategy, now what we're going to do is the same thing, except instead of paying the debts directly, we're going to put it into the line of credit. And so now we're building compounding interest, tax-free growth in our policy, and we're leveraging a line of credit that is going to build equity over time that we're going to have access to. And we're going to use that line of credit to eliminate the debt with the velocity banking strategy. So when you pay it off, what's left is going to be a whole life insurance policy with cash value that will continue to grow for the rest of your life instead of an empty bank account. This is an accelerated debt to wealth transfer. Velocity banking plus infinite banking equals infinite velocity. The most efficient way of cash flow hacking. Your next step would be to schedule a call. And with that, we can run your numbers. We can discuss the strategy. We can take a look at your credit. Just for scheduling a call, you're going to get a free electronic copy of Chris Kirkpatrick, the founder and owner of Life 180, the agency that I'm a part of. You're going to get a free book copy of his book, Cash Flow Hacking. You're also going to get my 4 numbers workbook for free. And if you want to take advantage of a complimentary credit assessment, I'll also provide you with a free credit assessment. No obligation or commitment. With that, we'll run your numbers. We'll talk about your debt strategies, your wealth strategies, velocity banking, infinite banking, putting it all together. And I'll help you to grow your wealth in a way that will be most efficient based on your values, based on your beliefs, in your time, at your pace, in your speed. If this video is of value to you, please make sure you let someone know who will let someone know to watch this content. Share, like, and subscribe. Let YouTube know that this video was of excellent value to you so that the algorithm shares it to more people. Thank you for watching. God bless you and take great care.